So we're going to keep it simple. We're going to start at 1973. So the US Treasury had 8,133 metric tons of gold. The mark-to-market price of gold in 1973 was $42.22 per troy ounce. So the US Treasury issued 11 billion US dollars worth of gold certificates to the Federal Reserve for that amount. Now, the Federal Reserve does not have any claims to any of the US Treasury gold. But what it did was it just created $11 billion out of nowhere and deposited that US dollars into the Treasury General Account, which is the TGA. The important thing to remember here is that the Federal Reserve only has claims to 11 billion US dollars from the US Treasury, but it doesn't have any claims to the US Treasury gold. What this means is that the US Treasury still owns the 8,133 tons of physical gold, free and clear, unencumbered. Let's fast forward 52 years to 2025, which is the year that we're in. Let's say the US Treasury wants to revalue its 8,133 tons of gold to mark-to-market value. What happens? The first thing the US Treasury will do is to redeem the Federal Reserve for the $11 billion of US Treasury gold certificate that was issued back in 1973. Next, the US Treasury will issue new gold certificates that is valued at $1 trillion US dollars sometime in 2025, when gold is marked to market valued at $3,500 US dollars per troy ounce. The Federal Reserve will then create $1 trillion US dollars out of nowhere and deposit that $1 trillion US dollars into the Treasury General Account, which is the TGA. The steps that I just described is actually done in one accounting operation. So the Federal Reserve would simply deposit the difference in US dollars to the TGA instead of the separate steps that I described. So what are the final results here? The US Treasury still has the 8,133 metric tons of physical gold allocated and unencumbered, meaning that the US Treasury physically owns the 8,133 metric tons of physical gold, and the Federal Reserve doesn't have any claims to it. On top of that, the US Treasury also has an additional $1 trillion US dollars in the TGA, minus the $11 billion that it paid to the Federal Reserve. So you see, guys, the Federal Reserve for the entire duration of the last 52 years never had any claims to the US Treasury 8,133 metric tons of gold. So if the Fed leased out US Treasury gold to its bankster buddies, you see Braun behind Taiwan, that's something else. That's not this US Treasury gold certificate deal that we have here. Remember what happened between 2001 and 2024 before the Fed started cutting rates? Well, the Fed engaged in the fastest rate hiking cycle in history. Normally, when the Fed engages in a fast rate hiking cycle and emerging markets and countries such as China cannot keep up with its own interest rates hike, the currencies of these countries would devalue against the US dollar because of the credit spread between its currency and the US dollar. So what did China do to keep the RMB yen, its currency, and the US dollar exchange rate within a very tight range without excess devaluation? Well, it started buying physical gold internationally. That's how it solved that problem. So luckily for China, it has its own gold exchange, which is the SGE. It allowed China to price set its own gold trade domestically in RMB yen. So you might ask, well, then how did China influence the Western gold price? So what's happening is, for most of the time, China has a higher domestic physical gold price than what the LBMA and the COMEX have. So once that happened, an arbitrage is created between the East-West gold prices. Because physical gold is cheaper at the COMEX and LBMA, there's a lot of incentive for Chinese banks and Chinese gold buying proxies to buy physical gold from the LBMA and the COMEX. So what they did was they stood for physical gold delivery. So the Chinese buying of physical gold at the LBMA and COMEX effectively drained those exchanges of physical gold, therefore pushing up the US dollar price of physical gold there. Chinese proxies and Chinese banks didn't only buy physical gold at LBMA and COMEX, it also bought directly at the gold miners and the refiners internationally. It used both US dollars and RMB to buy that gold. And then the Chinese banks and Chinese gold buying proxies would take that gold back to China, to the SGE, and sell it to the Chinese public via SGE, or they sell it to the PBOC directly. Okay, so that gold buying in China is in RMB yen at the SGE or by the PBOC. And when gold buying in China heats up, it pushes the RMB yen price of gold up. And then the cycle restarts itself. So do you all see what's happening? The US dollar price of physical gold and the Chinese RMB yen price of physical gold are going up together in sync. That means both the US dollar and the Chinese RMB yen are devaluing against physical gold at the same time, at the same rate, in sync. And that's how the Chinese government is keeping the Chinese RMB yen and the US dollar exchange rate within a tight range. Physical gold is the common denominator in this equation. So just one last thing. On top of COMEX, LBMA, and gold miners and refiners, the Chinese banks and Chinese gold buying proxies are also buying a lot of physical gold at London at the OTC market. And one final thing. The Chinese government has plans to issue around 600 billion US dollars equivalent of Chinese sovereign bonds in RMB yen. And the Chinese government has recently set up a reverse repo facility to allow it to conduct its own QE program to buy a lot of its own sovereign bonds. If that happens, China has to buy even more physical gold to keep the Chinese RMB yen US dollar exchange rate stable within a tight range.